Let's take the discussion forward with Manish Sonthalia, CIO at Emkay Investment Managers, joining us. Manish, morning.
Morning.
Manish, how are you observing the markets right now? Are you constructive on markets given the way quality of earnings are playing out, or would you be deploying your money on the side or the inflow that you're getting only after this key event actually plays out? Because you would perhaps want to take a relook at your framework and the tilt of the portfolio.
No, I think given the situation where we are in as far as the elections are concerned, don't think we could have a outlier event on the negative side. So from that perspective, fully deployed as far as the corpus is concerned. And I think as far as the earnings is concerned, broadly the earnings have been in line. What was not expected to do well has not done well. So IT was not supposed to do that well. Their earnings have come as muted. But otherwise, automobiles, banks, pharmaceuticals, capital goods, they have all delivered on numbers. Metals and oil and gas was again supposed to be muted. So I think all in all, the expectation of the result season from where we began the earnings season was a 5 to 6% earnings growth for this quarter. Except for oil and gas and metals, I think we stand good as far as the earnings growth is concerned. It will broadly be 13 to 15% sort of earnings growth for this quarter, sectorally, except for metals and oil and gas. So that would be in line with I don't see too much of a negative surprise as far as key numbers of companies are concerned, at least in the large cap space. And I think that would also be likely in the mid cap.
Ask you about your holdings in capital goods stocks. At least the large cap universe not only came out with good numbers, but even guided on very positive outlook. But is valuation becoming a bit of a challenge there? Are you moving your capital good positions to down the market cap curve, or you're holding on to them? Perhaps not adding, but at least holding on to them.
So capital good companies move more on account of order inflows rather than actual execution on top line. So it is basically book to bill which matters. And since the outlook on the book to bill stands good, even now for the next few years, I don't think market will take negatively, even if there is, let's say, a slight dip in margins or slight underbeat on the top line front, because the outlook and the visibility factor is what gets mattered. And since the outlook on both the government capex and the private capex seems to be pretty good, I would believe that both the large caps and mid caps, whatever we have, we continue to hold them in spite of a few companies saying that the next 2 quarters is going to be muted or first quarter is going to be soft because of the election. I think markets would look beyond that and would move to the second half of fiscal 25 and on to FY26. And from that point, I think outlook seems pretty good on both top line earnings and EBITDA. From that point of view, I think valuations are likely to hold. It's not going to come down. There's no case of booking profits in capital goods space. Likely to remain with elevated valuations, but that's the nature of the business. Markets are moving away from consumption-related themes to investment-related themes after a very long time. I think this is just the beginning of the upcycle in private.
That's quite a bullish note, really, on the entire theme. But the other thing I want to talk to you about, Manish, is also the PSU pack, and I'm going to, keep the banks out of that segment. Are you as bullish there as well, or do you think there is that event risk of the election which could play sort of spoil sport in the kind of rally that one has seen in the entire pack?
On the contrary, I would believe post the election, the PSU pack is going to get massively re-rated. I mean, that's my personal view. From the point of view of the fact that if you look at the outlook on growth, that is pretty good for most of the PSUs, I would believe. If you look at the valuations, I mean, they are very, very reasonable. So OMC is maybe trading at a 5 to 6 P, or let's say a 4 to 5% dividend yield. So be in the case of, let's say, power financiers. You name it, across the board, PSUs would have both growth and valuations on their side. And I think when you are looking to find value in such sort of markets, this is one pocket where, I don't think you can ignore this pack as a whole for a great length of time. And from that point of view, monopolistic PSUs, so to speak, and including PSU banks, where I think valuations are far more conducive, I would believe that it's an overweight sector to be in, particularly positioning a portfolio even before the elections are out or maybe even after the elections are out.
Interesting. And I want to dig deeper into that. Other than the OMCs, what are the other pockets which are looking interesting? Because PSUs is such a large bucket.
So monopolistic PSU companies, you have the defense companies, you have the logistic companies, you have the power financiers, and you have the oil marketing companies, you have the commodity companies. I mean, whole lot of them, and all of them are trading at very, very reasonable valuations, I would believe. So if you believe commodities, this is going to be a dark horse going into the future, look around you and find the commodity companies, particularly in the commodity space, and you will find great value. So it's not only about the earnings growth, but it is also about very decent valuation. It's also about the very lucrative dividend yield. And for how long can you ignore all these things?
That's interesting, talking about a re-rating post the election outcome for the entire PSU pack. And where do you stand when it comes to pharma? Is it going to be very selective, looking at names perhaps within the large cap space, or is it the entire spectrum?
So when we talk about pharma, first to be noticed is the CDMO space, because China plus one is now a reality out there. You have a new legislation get passed, which will uh, somewhat make it difficult for Chinese companies to get new contracts, and this is what I'm given to believe. So the CDMO space, particularly when it comes to the biologics, is going to be a very interesting area, and you have very niche companies out here which will look to get some accelerated business and would translate into high margins and earnings and all of that. The second in line is basically generic pricing has been very decent when it comes to the US. The price erosion that we were used to seeing in companies exporting out of India to developed markets. I mean, gone are those days when you saw double-digit pricing erosion out there, and that is lending a helping hand to US-based generic companies, manufacturing and exporting out there. And within India, I think it is the chronic space, which is obviously growing and is much more lucrative when it comes to margins. A combination of two or three of them, all of them put together, would stand in good state when it comes to your earnings visibility. Key raw material prices have also been on the softening side. We didn't see too much of dent as far as the margins are concerned. In fact, it augmented margins, so to speak, when it came to gross margins. So all of these things are working in favor of pharmaceutical companies. I mean, you could also say that diagnostic companies may be looking at an uptick now, given that all the trough and the peak when they went through the COVID cycle is now there in the base. So in that space tends to look quite interesting. Not all of them, but surely a few of them. So all in all, positive vibes for the pharmaceutical space as well. I mean, there's a whole lot to choose from within that space. One got to take one's own pick in terms of preferences.
This specialized bearing space, you have some big names out there like Schaeffler. I was looking at the way, bearing stocks are coming back after almost 1.5 years. What's your call on specialized engineering as a specialized engineering bearings related plays right now?
The size of the market for bearings is not that big, and within that, the profit pool is shared between these 3 or 4 players, known ones. And it's a direct play on your capital recovery cycle. Automobile is also doing quite well. So both the industrial space as well as the automobile space is doing quite well. You have few of them which have a bigger share in the industrial bearings. A few of them have a bigger share in the automobiles. I think all of this translated into much better than expected numbers that were expected by bearing companies this quarter. That came as a sort of a positive surprise. Maybe it was on account of railways giving them a lot of business, or the automobile space, both the two-wheelers, passenger cars, 3V, they are doing quite. So from that point of view, I think the call that is need to be taken out here is the valuations. Otherwise, I think it's going to chug along well along with the automobile, buoyancy that is there in the system as well as the industrial recovery. It is all about a call on valuations and how far growth that you can see in most of these companies.
Catching your eye, Manish, when it comes to the new IPOs, upcoming or even recent listings?
Really not a great fan given the frenzy that is there in the IPOs. I mean, there's a whole lot to choose from within the listed space. But a few of them are definitely worth looking at when they come out, in the next few months. But otherwise, I would restrict the pop that you see on the listing date. I mean, takes out the fizz from most of these IPO companies when it comes to visibility in terms of justification of valuation. You got to see time correction for the next 1 year to see returns get made because you really don't get any allocation out there. And when you come to buy it in the market, the first day takes out the entire appreciation for the next 1 year at least. So keeping myself totally restricted out there as far as I feel.
A lot of large banks in your portfolios, but are you also playing the financials without the lenders? Which bucket do you like?
The platform companies, I think when it comes to the next many years, you would see non-linear growth in most of them, particularly the ones that are...
BSC.
No, so basically capital market platforms, depositories, exchanges, brokerages, wealth management platforms, all of them will see some hyper growth. Those would comprise of the non-linearity when it comes to earnings. And obviously being platform companies, you can actually make a model when it comes to growth till perpetuity. And on that basis, valuations could be justified. So these are perpetual businesses for many years to come. And the longevity of growth when it comes to the financialization of savings gives a whole lot of headroom to look beyond the lenders. Even the fintechs, etc., they are quite good.
Yeah, okay, fair enough. And, just a quick word on where you believe valuations are looking a little bit stretched at this point in time, and therefore maybe it would be a no-go when it comes to looking at that sector?
And FMCG, broadly given the growth visibility, of course, I know that, corporates have talked about expected demand recovery, but even now the valuations don't seem to be in sync with what the growth seems to be there. A few of these consumer discretionary names also, have been quite soft. I've traded at some elevated valuation. Our business models are pretty good, particularly when it comes to a few of these retailing companies. I mean, they will see growth, but what is the PEG that you want to pay? So, out there, valuations could be a sort of a concern.
All right, Manish, we'll let you go on that one. Thanks so much for joining us on the show today. That was Manish Sonthalia of Emkay.
If you like this video, then like, share and subscribe to ET Now.